Hello, everyone. Welcome to today's session called Protecting the ACH Network, an Expert's Guide to Account Validation Solutions. As one of the fastest growing areas of fraud, online payment fraud is expected to exceed 343 billion in merchant losses globally between 2023 and 2027 per Juniper Research. That's a really big figure. Let's put that number into perspective a little bit. 83% of all countries have a lower GDP, a lower gross domestic product than that figure. So we're certainly up against a pretty large number. Now, according to Nacha, the ACH governing body, ACH originators of web debit entries are in the best position to detect and prevent fraud-related payments that they're initiating. So as a result, new regulations are emerging across the US requiring the use of fraudulent transaction detection systems to screen web debits for fraud. During this webinar, our speakers are going to highlight a few things for you all. First, we're going to highlight the rapid growth seen in payment transactions across the ACH network. Next, we'll dive into some of the new regulations that have emerged to thwart associated payment risks. And we're going to provide an overview of the types of solutions available for bank account validation. Those are going to include things like consumer permission solutions, data-driven solutions, and lastly, microdeposits. Last but not least, we'll introduce our newest solution, Socure Account Intelligence, cover its capabilities and competitive differentiators as a bank account verification solution. Now, before we dive in, I'll introduce the speakers that you see here on the screen. Today, you're going to hear from Amy. Amy is a Senior Director of ACH Network Rules at Nacha, leading working groups in the payment industry and collaborating with participants on changes to the operating rules. Amy has over 20 years of experience, previously working at Navy Federal Credit Union, FIS, and Visa. Next, we're going to hear some perspectives from Rusty Pickering, the President and Chief Operating Officer of Ingo Money. He's an expert operator and legal strategist in the areas of risk management and payment technology. Prior to Ingo, Rusty was a senior partner at the office of Nelson Mullins, Riley, and Scarborough, where he represented technology companies and private equity firms in the areas of security law and corporate governance, just to name a few. Finally, we have Eric Woodward. Eric is a financial technology executive, passionately focused on transforming consumers' financial lives through digital identity and payment solutions. Eric has spent the last decade helping banks in the US create Zelle, and he spent over 25 years leading and advising financial technology companies. He's the author of 9 patents related to digital identity and payments and sits on a half dozen advisory boards for fintechs. I'm very excited to bring the three of you together and hear your perspectives on payment risk and account validation options. And to the audience, during today's session, if you have any questions, please feel free to add them in the Q&A tab on the side of your screen, and we'll save some time at the end to address those. Okay, with that out of the way, let's get started. Amy, I'm going to start with you. I would love if you could set the stage around payment trends in the ACH network and familiarize the group with the Nacha web debit rule for bank verification prior to payment transactions.
Absolutely. Thank you so much for having me here today and for joining us. I'm very pleased to sort of set the stage here to really talk about what's going on in the ACH network and sort of, as we say, the goodness of Nacha. So in 2022, we had another strong year of ACH volume, 30 billion payments, totaling almost $77 trillion. So on this slide, you see a bit of that breakdown. One of the things that makes the ACH network unique is that we handle both credits and debits. So that's pulls of funds out of accounts as well as pushes of funds into accounts. So when we look at the number of transactions within the network, we fairly consistently run about a 60-40 split in terms of the number of debits, that's the 60%, the pulls of funds out of accounts, that's consumer or non-consumer, to the number of credit transactions, pushes of funds through the network. When you look over at the value of those payments, the dollars flowing through the network, it flips and a little bit more unevenly, but we have many more credit dollars flowing through the network than we do debits. But again, one of the unique attributes of the ACH network within the United States and internationally, again, is that we can support and we do support evenly the both types of transactions. We had 3% volume growth in terms of the number of transactions, and I'm going to talk a little bit more about that in just a moment. But again, still strong growth. Again, when you look at the base number of the number of transactions that are flowing through the network, so very happy with that. The ACH network continues to be thriving, and value of payments up over 5.6%. So on our next slide, we get into a little bit more of that breakdown that I was mentioning. And so a little bit about how we categorize these numbers. If you follow our statistics on our website, you'll notice you can see these same breakdowns quarter over quarter so that you can have a good understanding of comparison. B2B, I think, is fairly self-explanatory. Business to business transactions, significant growth within the network, almost 12%. We have been seeing that grow at even a higher rate since the pandemic. Challenges that were brought about by folks not being able to be face to face and signing ledgers and checks and things of that nature were a catalyst for organizations to move into an electronic arena for their payments that had not done so yet. And of course, once you make that kind of investment and change, you're not going to be going backwards. So we're continuing to see very strong growth in the B2B space since 2021. And we categorize those B2B transactions, again, as I said, business to business. That's looking at both debits and credits. The next category that we mention here is labeled as direct deposit. So these are credits to consumers from any kind of an organization. That can be a business, that can be, again, like a payroll transaction. That's typically what we think of when we say direct deposit. But it can also be government transactions, federal, state, local, etc. And so, rather unusually, we do see a little bit of a decline in that number. And that truly is due to some of the unique circumstances around pandemic related payments. As we're comparing over to 2021, we still had a lot of pandemic related payments that were flowing through the network, be it from the federal government in the form of EIPs or advanced child tax credits, down to state and local levels where there was still enhanced unemployment programs in place. There were also several states and even county governments that were offering assistance payments similar to EIPs that were going out in 2021. And so that's where we've seen a slight decline in that number. However, we did notice that that was normalized as the year continued. So we had more of those types of payments that I mentioned related to the pandemic earlier in the months of 21. And so as we moved later, for example, into the fourth quarter of 2022, we saw those numbers break even. When we subtracted out the federal government, so that's not even the state and local governments, but just subtracting out the federal government, we still saw an increase of almost 5% in non government related payments in the ACH network. So, as we move through this year, you're going to notice that figure start to normalize, as I said, and sort of be reflective of really what's happening in the economy without the pandemic related issues. Internet, how we categorize internet is specific to debits, so pulls from consumer accounts to businesses that were authorized over some sort of unsecured network. So that includes text, mobile apps, uh, browsers, etc. Anything that happens over an unsecured network is categorized as what we call a web debit, and it's included in this category. So again, remember, these are just debits, pulls from consumer accounts. almost 8% growth there, which is strong. We have had this category around for at least 3 decades. We had seen a little bit of flattening out there, but again, since the pandemic, have seen even a little bit more of a shift in consumer activity in terms of those non face to face types of payments that end up in this category. P2P are specifically credit payments. This is how we categorize them for our purposes. We have a standard entry class code that is specific only to the credit side of these transactions. So when we look at that number of under 300 million, that seems to be a small portion of the network, but we have to realize a few different things. Number one, this doesn't include on us transactions. So if one party's at a large financial institution, the sending party as well as the receiving party is at the same large financial institution. Most cases, that's not going to go through the network. That's not going to be categorized here. Also, again, it's the credit side of that P2P or account to account transaction. And so we aren't seeing where there's a third party service provider involved. We're not seeing the debit side of that transaction in this category because, as I said, it's specific to that credit side. And then once again, still seeing very strong growth there, 8.6%. So continuing to see the shifts both on the consumer side as well as the business moving over to electronic and non face to face types of payments. And then finally, we always call out our healthcare segment because the ACH is the designated rail for electronic healthcare payments, and still seeing very strong growth at 6% there. So, over the last 10 years, the value in the network has continued to increase by more than $1 trillion each year. So, this is really, calling out why we're all here and why it's important that we're talking about these types of requirements in the network because it truly is the backbone for commerce in this country. On our next slide, we talk a little bit more about same day ACH. So about 6 years ago, we went going on 7 years. We went into a new level of settlement available in the ACH. Previously, it was always next day you submit a transaction. The earliest, excuse me, that the money is going to move between financial institutions was going to be at 8:30 the next morning. And so now, as a result of same day ACH, we actually have settlement options. Again, the movement of the money between the financial institutions 4 times per day. So, significantly speeding up the processing within the ACH network. And we are truly seeing organizations taking advantage of it. So, last year we had almost 698 million payments flow through the same day ACH windows for $1.7 trillion. When you look at the breakdown of those types of payments, it looks very much like the overall network breakdown as well, about 60/40 in terms of the number of transactions, debits to credits, and slightly heavier on the value of the credits over the debits. Excuse me. Very strong growth. 15.5% in terms of the number of transactions that are flowing through those same day settlement windows, and 86.3% increase in the value. So the actual dollars that are flowing through. On the next slide, I can explain a little bit about why that happened. So, not only was 2022 the first year that same day ACH value passed the 1 trillion mark, and it passed it significantly, 1.7 trillion, it was really due to the new per transaction dollar limit of $1 million. So, prior to March of last year, the per transaction limit was $100,000. We raised that to a million. And as you could see in that 87% growth in the value, businesses truly were taking advantage of that. And we saw, again, the jump in the number of transactions as well, because each time we've expanded functionality in same day ACH, we've seen new users really take advantage of that by saying, okay, now that more of my payments are eligible for same day ACH, I'm going to go ahead and fully implement this. Whereas perhaps they had not started processing before. Same day ACH transactions because of the percentage of the eligibility that they were experiencing. And so, with that change, again, it really moved the needle on our same day ACH volume. So, we started running about 2.8 million payments average per day last year, with a value of $6.8 billion each day going through same day ACH. And even though I wish I was getting transactions between $100,000 and $1 million to my account, in reality, that limit change really was impactful for business to business payments. And we can see that here in that growth in same day at 44% over 22. So, again, overall network volume grew 12% for business to business transactions, but 44% in same day. So, again, really seeing folks taking advantage of the functionality of the network. All right, so we can move on now and get a little bit more topical here and talk about account validation. I'm not going to spend a lot of time on this slide because this is really the crux of what all of us are going to be coming back to throughout this session. But just to start to lay a foundation, there are multiple types of account validation. What we refer to as basic account validation is simply making sure that an account is open and valid for a transaction type. In our case, we're talking about ACH transactions. There's a number of different ways that you can do that through the network, through pre-note entries, through micro entries, but then also with the assistance of vendors. And there's different flavors of vendors and different flavors of services in terms of data consortium. So looking through, a big database of information, as well as credential validation, where you're actually relying on input from your user. And then we're going to talk more today about different types of advanced account validation. There are a lot of different types of layers that can be added onto just what we're calling that basic account validation, that can help you determine a lot more information about your user or about an account other than just that it's a valid account number that can accept an ACH transaction. And so, as I said, we're going to all talk more about this today, and talk about what you can gain, and then some of the things that you may need to be aware of. For example, where things may require consent, when you're using some of these different layers. So we can go on to our next slide here. And I'll just talk from the Nacha perspective, what we have been saying about account validation over the last several years. So, what really brought everything to the forefront was the web debit rule. So, that's our green circle here on the slide. This rule went in a couple of years ago, started to be fully enforced last year, which is that when you are doing those web debits, so that was on that slide that I showed for different types of transactions, those consumer debits that are taken over some kind of unsecured network. The rule requires, as part of a commercially reasonable fraudulent transaction detection system, that account validation be used if it's the first time you're seeing that account number for that customer and the transaction is going to be a web debit.
Let's jump into the panel discussion. One thing that Amy mentioned that I thought was really fascinating to hear was that in 2022, it was the 10th consecutive year where the total value of ACH payments increased by at least 1 trillion, a really huge number. I also recently read from Business Insider that paper checks are expected to be extinct by 2026 due to this digital payments trend. Yeah, gone are the days where you used to say balance your checkbook. So Rusty, as the COO of Ingo Money, a company whose value is centered around frictionless and safe money movement, I'm really eager to hear your experiences with bank account validation in the ACH payment processing. What have been some of your biggest pain points to date?
Yeah, so thanks, Emily. We at Ingo, we facilitate all sorts of money movement into and out of accounts for all sorts of people, and we use the multiple rails for that. We use card rails, we use the ACH network, and it's interesting. Every network that you use has a different way that you validate the account, that you do risk management. And on the card side, for instance, if I want to enable somebody to pull money out of their traditional bank account and to fund their shiny new digital bank account, well, that's a transaction that's just ripe for fraud. If you can enable somebody to set up a digital bank account and start pulling money out of other people's bank accounts, that's a really good business model if you're a fraudster. And there's multiple ways you can enable somebody to pull money out of that traditional bank account. One of them is with a debit card. And so when you're using a card, you've got central databases that you can ping to verify the card number, the CVV, the security code on the back of the card, your address, etc. And most of these are generally not publicly known information. And so you can validate the card, and hopefully you're validating that the person who's using the card is the person who they say that they are, although that's not always true. On the ACH side, you're using bank account credentials, the account routing number. Well, account routing numbers are not secret credentials. If you've written a check, and a lot of people don't write checks anymore, but back when we used to write hundreds of them, it's right there on the front of your check. So anybody you ever gave a check to has your account routing number. So it's not a secret number. So if you want to validate a couple of things when you're pulling money out of somebody's bank account, one, you want to validate that it's actual account, which you can do centrally. You can validate the account routing number. You can validate that it's a real account, that it's open. But then you also want to validate ownership of that account. And that gets a little trickier because there's no centralized database of owners of an account. The issuers of the account know who owns the account, but not necessarily Nacha or any central repository. So there's sort of been three methodologies used to verify ownership of the account to make sure that you're taking money from the person that you think you're taking money from. The sort of historical method is micro deposits, where you get 2 or 3 very small deposits put into your account. You then have to wait a couple of days until they show up. Then you have to go log into your bank account and look at what they are, and then come back to the person that you're trying to authorize to pull money out and verify for them. It's a fairly lengthy, consumer intense, logistically intense process. It takes up to a week, and you're relying on the consumer to not only leave the process that they're in, but log into their bank account and then come back. And there's a large abandonment rate for that. It's not really a good customer experience for anybody. The second method is to use a vendor like a Socure who's got a consortium of data, and to ping a centralized database and try to match the account routing number against the ownership of the account. That's probably good for about 40 to 50% of the accounts in the United States. That consortium data is subject to the banks that are contributing. So you get about 40 to 50% approval. It's good for about half the accounts, but it doesn't work for the other half. The third way is to use an open banking solution, which requires the consumer to provide you with or to log into their account. So the consumer is logging into the account they want to pull money from. That then validates that they own the account because they have the username and the password. And then you can validate that the account exists, that it's open, who owns it, and a fourth piece of information, which is how much money is in there. Because when you're pulling money out of an account, it's good to know not only that you've got the right owner, but that the amount of money that you're trying to pull is actually in the account. If you're pulling $1,000 out and there's only $10 in the account, you won't know that for a couple of days because it'll bounce. So these are various methods that you can use. It may require a combination of them. So in order to not have the customer have to give me their login credentials, I might try to first use consortium data to validate the account. And if that doesn't work, then I can fall back to an open banking solution like an MX or a Plaid or a Finicity or one of these vendors that does this. And at that point, what you've done is actually validate the ownership of the account And that's perfectly good if you are in fact dealing with the owner of the account. And I think we'll get to later some of the perils with making that assumption and then what you can do about it.
Got it. Thanks for sharing that, Rusty. Some of the pain points and some of the options that people have to solve for the bank account verification. I'm sure that some of those pain points have been exacerbated as of late due to the increase in ACH use that Amy pointed out earlier. Now, I know that Nacha isn't the only governing body that has stepped up to the plate with new applicable regulation. I recently saw some changes at the state level. Pennsylvania amended their fiscal code in July 2022 to protect state electronic fund payments and collections against fraud. They direct agencies to obtain account validation services now. And I also saw that it's not limited to the US. The European Commission released draft regulation last year that requires providers to check the match between the account number and the name of the beneficiary before any instant payments are made to warn the payer about any discrepancies. So definitely a lot of momentum behind this topic these days. Now, Eric, you were an early pioneer of digital payment trends with your creation of Zelle, and now you've been a provider of account validation solutions through Socure. So you've been witness to this digital payment trend from many different angles. I know Rusty shared some of the options that are on the market for users, but what can you share for folks on the call who are looking to enable frictionless and safe money movement or funds disbursement?
Yeah, thanks, Emily. And I think early pioneer is just a euphemism for old, but I appreciate the question. And I did get a chuckle, as did Rusty, when we talked about checks, sunsetting or going extinct by 2026. I think we've been saying that for at least 20 years. But the great thing is with Amy's work and Nacha's work, whether it's 2026 or 2036, it's clearly happening, sooner than anybody might, expect. And we're excited to be a part of that with, kind of these new real-time transactions or near real-time, same-day ACH transactions. And, we're big proponents of, kind of the web debit rules that are requiring this validation because, fraud will run rampant when you don't have the understanding of who's on the other side of the transaction. And so, of course, as Rusty touched on, we think of kind of three primary ways that you can validate account information. Clearly, there's the consumer permission, where the consumer logs in. Some customers aren't super comfortable with giving over their account credentials. I think the banks are doing a great job of putting out their own APIs and or creating basically ways that you're logging directly into the bank and not sharing the credentials with a third party. But having that consumer permission consent to validate ownership and status is one great solution. Another is the passive solution that's data driven. And so a requester just submits their account number and routing number, and then kind of any associated PII that they want to validate. And on data driven solutions, you're either going back directly to the financial institution that created the account. That's always, of course, the preferred methodology when you can have sort of a source of record validation, or you're leveraging data that you see, transactions you may have access to from ACH, and effectively you're creating scored accounts and or a probabilistic understanding of who the owner is on that account. And then lastly, there's the kind of non-real-time solutions, which include micro deposits or a $0 payment or even voided checks. Now, of course, those solutions remind us a lot of KBA questions. What color was your car 23 years ago? And of course, we think that they're not ideal, but they are a way to validate. But I think what's interesting is that there's some new real-time solutions coming out in that kind of micro deposit space, which would be a lot more accurate and a lot more consumer friendly. So none of the options that I mentioned are bad. We think, in fact, they all work well together, and that you should, there's no one silver bullet. And so you need to kind of accommodate your preferences around cost, accuracy, timeliness, and importantly, the consumer experience, right? If you want to have something that's passive or active in terms of the authentication and the consumer's effort. And so, the consumer permission ones, for the customers who are willing to share those credentials work well, but can be timely and costly, depending upon the service providers that you're using. Data-driven solutions tend to be more affordable, have less friction, but are, of course, limited to the data sources that you have access to. And then ultimately, the micro deposits, again, it's a check mark to validate control of the account, but there's no way to leverage that to actually validate the ownership of the account. So Socure has recently announced, it's about 3 months old now, that we have entered the space of payment risk and are helping our customers understand, as they onboard new sources of ACH, who the account holders are and whether or not the account is actually open. And so we've had really good traction so far in the space with customers who are looking to really instantly verify the domestic bank account status and ownership. And we're excited about the additional types of payment risk that we'll be able to offer based upon all of the transactions that we see, but also importantly, of course, based on our bread and butter of understanding who the account holders are when they're being created. So if you're going through a Socure KYC product, and then you understand that this person's a real person, they are who they say they are, all of their tokens match and are associated with the individual. Our customers decide to then open up an account, and the consumer then brings an account from a third party to onboard. We can help tie all of that together through a single API in real time. So we're really excited about being in this space and working closely with Nacha on that.
Wonderful. Thanks, Eric, for sharing all of that. I understand that many users will use the solutions that you referenced in a waterfall pattern, starting with the economical, low-friction, data-driven solution, maybe followed by consumer permission products to catch any bank accounts not covered in the aforementioned solution, and then lastly, resort to those micro deposits. And Amy, I know that Nacha's web debit rule, it appears to have enough flexibility to allow users the freedom to waterfall back and forth between different account validation options based on their preferences. The rule requires the use of commercially reasonable fraudulent transaction detection systems prior to initiating an ACH web debit transaction. I'm hoping that maybe you can speak a little bit more about the options that users have when adhering to the rule, and then additionally, if not just starting to see the desired results since the rule went into effect early last year.
Absolutely. Thank you. So yes, the rule is flexible. We do not specify any particular method of account validation. We do require that basic level, which is verifying that the account is valid and is available for an ACH transaction. But you mentioned another key term, which is a commercially reasonable fraudulent transaction detection system. So it has to be commercially reasonable. When we started training on this new rule, even before it was implemented, one of the things that I would say is it's important to understand sort of what your peers are doing. If you're in an industry, there's 95 of you, let's say, and 94 of your peers are performing name matching, then that now becomes what's commercially reasonable for your industry. So it's important to kind of keep up with that. So there are different levels of things that you can do. As I was starting to mention in the slide previously, there are micro entries, which have been mentioned a couple of times. They're not the fastest method of verification. They can be done using same day windows, and so those transactions can show up in a matter of hours. But it does require that receiver to come back and perform an additional action. There's also pre-notification entries through the ACH network, which again can be done same day, but they're validating again just the account number and that bare minimum. And so then we start to get into those different levels of things that we've been mentioning today, which start to move into that commercially reasonable realm. In terms of, it's not just the web debit rule. That's where we started out, but about a month or so, there's going to be another request for comment coming out from Nacha, where we are moving on recommendations that have come out of our expanded risk management framework, which I think, unfortunately, there were some technical difficulties and I wasn't coming through about that. But we are going to be asking the industry about expanding that beyond just web debits, as we've called a best practice, for a number of years for consumer credit transactions, as well as non-consumer credit and debit transactions. We feel that there's definitely a place for account validation to make sure that we are getting funds where they are intended to go and that we're protecting against unauthorized debits. In terms of what we've seen from the industry thus far, yes, I do believe that we are on a good path. Um, we don't have, we're starting to analyze return numbers, but I think even more so than that, it's the conversations that we're having with industry participants who, are now about a year into their implementations, and they're really starting to analyze the information that they are getting either from the method that they have selected or the vendors that they are working with, and starting to make the adjustments needed to really be able to act and understand on the data that they're getting out of their systems. And so I think that that's really crucial, and where we're going to continue to see, the figures show us where we are after, again, that sort of adjustment period that folks need to go through.
Great. Thanks so much, Amy. We've actually had a couple of questions pop up from the audience. So I'll read the two of those questions, and Amy, feel free to opine on them. If not, I think these segue really nicely into what Rusty was intending on speaking to next. So for the group, the question is, who's responsible for enforcing the web debit rule? Is it the financial institution or someone else? And then, does account validation include the name validation and not just that it's a valid routing and account number? So Amy, feel free to jump in on those. If not, I'm happy to turn it over to Rusty as well.
Well, let me start on that from a Nacha perspective, and then folks can talk about it sort of more from the real life perspective, right? So in terms of enforcement, Nacha goes to the financial institution. That's where our enforcement lies. That's where the agreements in our rule language. It states that the ODFI holds the warranties. So that's the financial institution that introduces the transaction into the network. But then there are going to be contracts in place from that financial institution, either with an originator or third party senders, that are then going to push that back. And that's up again to those contracts. And I'll let other folks talk about, how that really happens in reality. But Notch is always going to knock on the door of the financial institution. And then from the rule perspective, the rule does not require name validation, but again, it's with that caveat of commercially reasonable. And so you need to be aware of what your peers are doing, and what would be considered commercially reasonable in your space. And I'll go ahead and turn it over from there.
Yeah. Rusty, I know that Ingo has taken this Nacha rule flexibility and really gone above and beyond in doing step-up fraud prevention in addition to bank account validation. So I'm hoping from that commercially reasonable perspective that Amy's talking about, if you can share with us what other types of checks you find to be useful in promoting trustworthy money movement, and then ideally maybe addressing that question that was asked about name validation in addition to the account and routing number validation.
The Nacha rule is very helpful, and at a minimum you need some commercially reasonable method to verify the account. But at Ingo, we think you need to go well above and beyond that, and particularly depending on the use case, right? So if you're going to push money into an account, so you're pushing insurance payments or payroll payments into an account using an ACH credit, you may only need to do account validation, which is just validating that the account routing number is valid and that the account is open and can accept a payment. And that might be sufficient because nobody is really stealing account credentials to fill your account full of money. But when you start talking about debits and now taking money out of people's account, then you need a higher level of validation. And so the first level is account validation, where you're just validating that the account exists and it can accept an ACH debit or credit. And you might be able to do that with consortium data with about 90% effectiveness, right? So for 90% of the accounts, maybe 95% of the accounts, I can verify that they exist. Then if I want to do ownership verification, I want to verify who owns the account. That's a little harder to do. So with a consortium data, you might get to 40 or 50% of the accounts to verify ownership, which is a different query than just account validation. And that's where you may need a layered approach to ownership verification and then fall back to open banking, consumer consent, and, God forbid, microdeposits to validate ownership. Now that you've validated ownership and say, I want to pull money out of Eric's account because I like to take Eric's money. So I verify that the account that I'm given is valid, and I verify that it's owned by somebody named Eric Woodward. And that's all well and good if I am in fact dealing with Eric Woodward, but maybe I'm dealing with somebody who has stolen his identity or is pretending to be Eric. And that's where you need to go above and beyond, in our view, the Nacha requirements, because you want to make sure that the person that you're dealing with is actually the person that they purport to be. Just verifying that the account is owned by Eric isn't good enough if I'm actually dealing with a fraudster in Southeast Florida or Eastern Europe or Nigeria or wherever they happen to be. And so there's other things that you can do. And it all begins with KYC, know your customer, verifying that the person you're dealing with is in fact who they say they are. And there's a lot of KYC that you can do. And then there's a lot of other things that you can do to help mitigate risk. You can look at the email address, and is that email address, how long have they had it? Is it a Gmail address, or is it on some burner website, some anonymous email proliferator that's frequently used by fraudsters? Is their phone number a prepaid number on a burner phone, or is it an AT&T number that's been in existence for 5 years? And then we also recommend, in the age of mobile, that you look at the device. The easiest thing to do is to get a geocode off of the device, and that helps you to determine if the person is in the vicinity where they should be in the United States, in the area where they're supposed to live. But that's easily spoofed. If I look at my son's location right now and I go over to Google Maps and I look and see where my son is, he's just as likely to be in Afghanistan as he is to be in Atlanta, because he thinks that's funny, right? And it's not hard to spoof a geocode. But there are techniques and methodologies that you can use to pull all kinds of information off the phone. What is the language? What is the currency? What is the time zone? Which data provider are they using? Is it a US data provider or a data provider in Africa or Eastern Europe? Who manufactured the phone? There are phones that are only sold in Africa or Eastern Europe that aren't sold in the United States. Is the language US or is it Ukrainian? Is the currency US or is it some odd currency? So there's all kinds of data that you can pull off the phone, and you can even hit databases and see user behavior on the phone and match it to Eric's typical behavior. So how do you hold the phone? How do you interact with the phone? And all of these things can be used to try to determine if the person is who they say that they are. And we would recommend that you use all these techniques at the KYC level before you even let people start to initiate these transactions. But then you should also use them on a transactional basis, because the advanced fraud, they're getting smarter all the time. And so, it's like a chess match. We figure out how to do something and they figure out how to beat us. They will actually recruit people in the United States to set up an account. So they'll use a phone that looks good, that's in the United States, and then the account credentials will be transferred over to Eastern Europe, where they will try to initiate transactions. So there's a lot of techniques, and it's a layered approach. Who are you dealing with? What is their transactional history and behavior? What do you know about them generally? And what do you know about their interactions with you? What do you know about their device? What do you know about their email? What do you know about their phone number? And you use all of this information to then calculate how much risk is there that the Eric that you're dealing with is in fact the Eric that owns the account you want to pull money from. And then you make a risk benefit determination, and and then you take variables until you get, you're going to have some returns and you're going to have some fraud. And so you calculate all of this until you get the amount of fraud that you can digest. You'll never get to zero. You just need to get to a place where it's low enough that you can accept it and digest it and consume it within the context of what you're doing.
Hey, Rusty, I think you make some great points, and thanks for sharing all of your experience in fighting this fraud. I know you guys at Ingo have spent a lot of time on the front lines of taking checks and then ACH transactions and even guaranteeing them. So it's not
We've
easy.
learned in the most painful way by losing a lot of money.
Yeah. If you don't take principal risk, you're just sort of a talking head. So we appreciate the insights you bring. And I will say, I think one thing that you touched on that I feel Socure brings a significant difference to the story. Most companies who have gone into account validation are leading with the payment risk, right? They're buying access to data or they're reselling solutions that are giving them information around the account itself and whether or not it's open and whether or not it's owned from the bank's perspective. But Socure actually comes to this from the perspective of the identity. And so we're very much focused on the very first part of an application for a new customer for an account. Is this person real? Right? So let's eliminate synthetics. Then is this person who they say they are? So we've got PII being shared with us, and we're validating across hundreds of sources to understand that this person is who they say they are. And then let's associate the tokens with them. So to Rusty's point, email address, phone numbers. It's not just physical address, which is of course important. And it's not just traditional PII like date of birth and social. You really want to go to the next level in understanding, especially in these virtual interactions, who this person is and how they're associated. And then, of course, as you start to understand that, then you step up into this behavioral biometrics and device identification. So you can layer in additional information and really try to eliminate as much third-party fraud as possible from the equation. And then, and only then, in our perspective, when you have certainty of the identity, should you feel confident in then pulling in money to be able to fund the bank account for a new bank or financial institution or whatever your use purpose is for ACH transactions. And so really trying to align those pieces together. And then, of course, not just associating the account, but associating the owner at the financial institution that's funding this. And so you can tie those two things together. And I think that's when you have the best opportunity to manage risk. And I want to touch on one other thing that Rusty talked about. When you think about validating status and ownership, it really depends where the customer is coming from, where their account is originated from. So, today there's traditionally relatively good coverage across the largest banks in the US. They make that data available fairly extensively. But as you start to think about smaller regional banks, credit unions, obviously all of the neobanks and any sort of challenger banks, that data is much more difficult to come by. And that's why Socure really feels like we're well positioned in this space, because we already have relationships with 1,500 customers from fintechs to the largest financial institutions in the US. And so our goal is to not have 40 or 50% coverage, but really to get to 100% coverage, just like we do on the identity side. And so we've got strong relationships and partnerships in place to help bring that visibility to light. So when consumers show up to open up a new account somewhere else, they can get access to the best rates. They're not denied service because somebody doesn't know whether or not that account's open or whether or not that individual owns them. And so we're really striving hard to eliminating third-party fraud and being able to focus on good consumers having great experiences.
No one's looking forward to you having 100% coverage more than me, Eric.
It's a tight partnership.
Yeah. Thanks so much, Eric. I know we're inching close to the top of the hour, so I'm going to wrap up the panelist portion of the presentation and open it up for Q&A. Before we do that, just want to thank Eric, Amy, and Rusty for your insights. To recap, some of the stuff we've learned is we talked about the rapid growth seen in the payment transactions across the ACH network, new regulations that have emerged to reduce payment risk. We heard an overview of the types of solutions available: consumer permission, data-driven, micro deposit, as well as some of those step-up authentication options. And then lastly, Eric, you highlighted Socure account intelligence for us at the end. So I see a couple of questions coming into the chat. We'll get to those in just 1 second here. While some of those questions are coming in, I want to also encourage the group to look at the poll tab. Depending on your screen configuration, it'll either be on the right side or the bottom of your screen. We just wanted to run a quick little poll to understand if anyone from this group is planning to attend Nacha's Smarter, Faster Payment Conference. It's in Las Vegas, April 16th to 19th. We will be there. We're going to be hosting an executive dinner. We'd love to connect with anyone who would like to continue the conversation with us. We will also be hosting a panel there with Dan Baum, the SVP at the Federal Reserve Bank of Atlanta, and Stephanie Kirkpatrick, the CEO of Orem. So again, feel free to indicate if you're going to be attending that conference in about a month, and we'd love to connect with you again there. To wrap things up with the rest of our time, a couple questions came in. One, I think this one is best directed to Amy. The question is, if an originator does not process 2 million transactions annually, do they still need a commercially reasonable validation tool?
Yes, they do. This is a little bit of a mix of two different rules that we had go in 2021. We have a data security rule that requires anywhere an account number that's been used in an ACH transaction is stored electronically, that it be rendered unreadable when, again, when it's in that stored uh, status. That pertains to participants that process 2 million or more ACH transactions annually. This rule does not have a threshold. This rule pertains to any originator of web debit entries, and that could be a financial institution or any kind of organization. This rule applies. So it is important, depending on the size of your organization, to talk about the scalability of the solution with any partners you may be working with.
Wonderful. Thanks, Amy. Another question we have here is, do bank account verification play a role in blocking the use of synthetic accounts? Rusty, perhaps you can take that one on and reinforce some of those additional authentication and step-up options that might be used for synthetic fraud prevention.
Yeah, so account validation is really in the debit context is being used to validate the ownership of the account that you're taking money out of, but that doesn't necessarily mean that the person that you're dealing with, as we spoke about earlier, is the person that they purport to be. And that's where synthetic identity and identity theft comes into play, is because somebody comes in and says that they're Rusty Pickering and they have my social security number and they have my address and they do a really good job of pretending to be me. And then they give you my bank account information and ask you to take money out of my account, and it's not in fact me. So account verification and ownership verification is helpful, but it's not the end of the inquiry. There has been, I think, a lot of, as the neobanks and the challenger banks have gotten established, there has been a need to enable the ability to fund those accounts from external accounts using both ACH debits and also card transactions like a debit card debit and AFT. And I think that the experience of the industry has been, as you enable those sort of real-time, near real-time, same day electronic methods for moving money from one account to another, the fraud increases, exponentially, because you have enabled a very effective method for somebody to empty somebody's bank account. And once they move it into an account that they set up synthetically, the money's gone. They go to the ATM and they pull it out and it's gone. And anytime you enable an effective business model for fraudsters, they're going to engage in it, robustly. And that's what we see. And so you really do have to layer in all of these other techniques to verify who you're dealing with and verify their device, et cetera. You've got to go way above and beyond just validating the ownership and the existence of the account you're pulling money from, or you will absolutely get chewed up with fraud. And that's happening now.
Yeah, thanks, Rusty. I think there's one more question about kind of where is this applicable? And I would just say, I think Amy touched on it with her great graphics earlier. It's broadly applicable across any use case where you're looking to make an ACH transaction. And so you can think about where people have paying their credit card bills, utility bills, or transferring funds from one bank to another. And in fact, of course, we have a very real timely example with Silicon Valley Bank, where a number of new accounts were being established at third parties. And so trying to validate the transfers to those new accounts were in fact legitimate transfers, and that the people who had opened those accounts were owners on the Silicon Valley Bank accounts was very difficult if you didn't have a process like this in place. And so, wanting to make sure that you have the best controls possible and you use them when necessary. So, I think that this is a powerful tool that can be used in any situation where you're transferring payments over ACH.
Thanks so much, Eric. All right, that brings us to our closing time. I want to just thank everyone for listening, and we'll send a follow-up email with a recording. If there are any additional questions or thoughts after the session ends, you can go back to the homepage where you will find more links to learn about Socure Account Intelligence or schedule a meeting with our team. So thanks again, everyone, for being here. And with that, have a great day.